Good afternoon, guys. Welcome to today's market update. We're starting to see some very interesting price action in the Russell 2000. It's been lagging the Nasdaq 100 that hit new all-time highs this year, and also the S&P 500, which actually reached new 2018 intraday high earlier today. But finally, we're starting to see some price action. So we're going to look at that. It's the same market we discussed about a week or so ago, and it looks like it's going to trigger a major head and shoulders pattern. So we're going to begin by taking a look at that chart. As you can see here, we're dealing with a massive head and shoulders, with the left shoulder being the October 24th low, the head being the December 26th low, and the right shoulder being the March 22nd low. We can connect these lines here via just a simple horizontal line, and the idea here is that if we actually close above this high, then we will most likely trade upwards. Now, we can already, just if you look at a 5-minute chart, see that it hasn't been very easy. We haven't necessarily seen sort of any winning side yet. We went upwards, probably triggered a few stop loss orders, and then we went all the way back down, pretty much to level seen here at about 2 o'clock London time, and now we're pretty much at that breakout point. I don't really know exactly sort of the best way to deal with this or trade this right now, but I'm guessing that if we trade slightly higher than today's high, maybe if we go above 116.01 or sort of close above this level, I think that will be a potentially a stronger likelihood of this being a genuine breakout. As well, if you look at this from a 30-minute chart, I'm suspecting that if we actually trade below the low here seen earlier today at about 11, also midday London time, then that will be perceived as a false break if we go all the way down here. So we need to be a bit careful. I think most likely the better option would be maybe let it go a little bit higher, let it actually close, because right now we're so close to that low. So there's a general risk really that we might just go up and then sort of go lower. So we need to be a bit careful. But otherwise, see what happens in the next few days. It's looking really, really interesting. From a risk-reward ratio perspective, I do really like it a lot. Say, just for the sake of it, we buy at 1601 or 1602. Stop loss goes somewhere halfway through maybe the price section we saw on Friday. And then we target the high here. Then that will be a risk-reward ratio about 6.28. But the actual head and shoulders targets is suggesting we should see a rally of about 21%, and that gives you a very good strong risk-reward ratio of 14.38. Now, I don't think it's going to be easy for the markets to quickly go up to that level if we ever actually go up to that level, but obviously we probably will do at one point. But most likely it's going to be up with a few percent, then a bit choppy, and then the market maybe goes down a bit, but we can still sort of, if you would trail this with a stop loss, get some decent risk reward ratios out of this. So it's looking really, really interesting. Of course, it sort of clashes what the general sentiment is saying right now. Like, as you know, the markets went down quite a lot from October until the end of last year, and since then the market has just been rallying. So I think a lot of people are again still quite surprised. We talked a bit about the GDP numbers in the video we did on Friday. People a bit surprised about the situation there. Some people were even a bit alarmed about the low inflation. But if you look now at the more timely PCE inflation figures, then you can see that core PCE printed 1.6% from 1.7, so slightly lower than expected, but still at a decent level. And more importantly, the headline figure of PCE showed that inflation increased with 1.5% annually versus 1.3 in the prior month's reading. So it sort of goes in hand with what I think is interesting, and that is that the fact that we saw low inflation in the first quarter GDP reading, but that has to do with the fact that crude oil declined the way it did from October all the way down to December, much like stock markets. But since then, prices are, what is it, with 45-50%. So that would definitely put some pressure on interest rates, I think, in the next few months. And I think that obviously is more relevant for the dollar, and we could see the dollar get a bit more support on the back of this. But it could also maybe lend some hand to the stock markets, which maybe in the past has been fearful of very low inflation, and maybe what that means for consumption. But overall, for stock markets, if you have good growth, 3.2% growth and low inflation, I mean, that's good, because the Fed won't be raising interest rates at that point. So that should again be more fuel for the stock markets. As I always say, we shouldn't let our, especially not our macroeconomic analysis, stand in the way of sort of the technicals. I think if you are trading short term as we are here, even if you even don't have such a long even if you don't trade short term, the technicals are extremely important. And again, we always need to be careful with the risks and use stop loss orders and sort of figure out levels that are important for the market. And that is why in the Russell 2000, if we do trade again below these levels here, then it's time to abandon that view, I think. And then we could have a breakout, but it might just happen later in the week, or it might never ever happen. So let's see what happens. Stock markets, cash market is going to open about exactly 1 minute now. Let's see if the cash market does what the futures are now projecting. Thanks so much for watching, and don't forget to subscribe to this channel. Thank you.